If silver is really printing near $110 in the US, while China is clearing trades above 125, that is not a quirky premium. That is the sound of a global pricing system losing its grip. And in a second, I'm going to prove something most people refuse to say out loud. This split isn't chaos, it's a sequence. A sequence so old it has names and dates and fingerprints. Right now, the world is sitting on roughly $251 trillion of total public and private debt. Let that number land, 251 trillion. And that debt load is still above 235% of global GDP. And the US alone is being cited around 38.4 trillion in national debt. When that's the backdrop, metals don't get expensive. Currencies get exposed. Here's the promise I'm making you at the start. If you stay with me to the end, you'll be able to look at any precious metal spike, any China premium, any sudden shortage headline, and you'll know exactly which stage of the cycle you're in and what tends to happen next. Not because you're guessing, because you're recognizing a machine. And before we go further, one line of honesty: this is education, not personal financial advice. I'm not telling you to buy, sell, or leverage anything. I'm showing you how the system behaves so you don't get blindsided by it. Now let's talk about the China 125 claim. Why does it matter? Because it's not just price, it's availability. In normal markets, the world has one price and different shipping costs. In stressed markets, the world has different realities. One place has supply on paper. Another place is paying extra to actually secure the metal right now in size. Picture two buyers on the same day. One is in New York looking at a screen price and thinking, I can always get it later. The other is in Shanghai trying to lock in physical supply for a factory schedule where later means production stops, contracts get missed, and people lose money fast. The New York buyer is shopping a number. The Shanghai buyer is shopping certainty. In calm times, that distinction barely matters. In stressed times, that distinction becomes the market. And here's your first open loop. In a minute, I'm going to give you one simple indicator you can watch, no fancy charts required, that tells you whether this move is still a rally or whether we've crossed into a repricing regime. If you've ever wondered how big resets begin, it starts exactly like this. Tiny gaps, then persistent gaps, then gaps become headlines, then temporary measures appear, and the public discovers the difference between a promise and a bar. So what happens next? You don't need predictions. You need a pattern. Here it is, 4 steps, and I want you to memorize it like a passcode. First, credibility is built. Money feels boring. Institutions feel stable. Trade expands. Credit expands. People stop thinking about money because the system seems permanent. Second, expansion turns into overextension. Costs rise. Wars, bailouts, welfare promises, industrial policy, demographics, interest expense. The system can't fund reality honestly anymore, so it funds it synthetically. Debt balloons. The currency becomes a tool. The solution becomes permanent. Borrow, print, roll, pretend. Third, you get the phase shift, loss of control. Not one dramatic day, but a new physics. The public notices prices. Bond markets notice math. Supply chains notice fragility. Foreign holders notice weaponization. And you get the tell that never lies. Paper claims and physical reality start to separate. Premiums widen. Delivery strains show up. The price you see becomes different from the price you can actually transact. Fourth, the outcome? Repricing and reset. The system either admits insolvency outright or performs insolvency through devaluation and rule changes. Hard assets become the scoreboard, not because they're magical, but because they sit outside the promise network. And silver, historically, goes from ignored industrial input to political problem faster than almost anything else. That's the mechanism. Now I'm going to prove it with 3 case studies, and while I do, I want you to listen for one thing: the moment where paper breaks away from reality, because that moment is what you're watching today. Cut fast, on screen. The pattern: credibility, overextension, loss of control, repricing, reset. First case study, Rome. And no, this isn't a history lecture. This is a diagnostic scan. Rome's early imperial currency system worked because people trusted it. The denarius and aureus circulated across a massive trade network. Taxation and salaries had predictable meaning. That is stage 1, credibility. Money feels like air, present, invisible. Then Rome expanded, and expansion costs money. Standing armies, frontier defense, political patronage, big building projects that signal legitimacy. The state faces a choice: raise taxes and risk unrest, or quietly weaken the money and spread the pain across everyone. Debasement becomes the lever. Coins keep the same face and the same stamp, but the silver content slowly gets shaved. That is stage 2, overextension funded synthetically. And here's what people miss. The state can do this for a long time, years, decades. Enough time for the average person to think, if it were a problem, it would have already broken. That belief is what makes the break so deadly. Then stage 3 arrives, loss of control. People notice the coin buys less, merchants raise prices, soldiers demand higher pay. Taxes get harsher because the real value collected is falling. Trust decays. And once trust decays, the state has to use decrees to replace what trust used to do for free. That is the key transition. Money stops being accepted because it's money and starts being accepted because someone is forcing it. And stage 4 follows, a cycle of reforms, coercion, and shrinking coordination. The empire doesn't collapse in a single explosion. It becomes less capable of coordinating itself because money is coordination. When the money breaks, the empire's ability to move resources breaks with it. That's Rome. Same pattern. Credibility, overextension, loss of control, reset behavior. Check. Second case study, Weimar Germany, 1921 to 1923. And I'm choosing this one because it shows stage 3 in high definition. Stage 1, Germany still had industrial capacity, skilled labor, and the memory of a functioning currency. People assumed stabilization would come. The system still had a narrative of competence. Stage 2, obligations exceed what can be raised honestly. Reparations, fiscal strain, political chaos. The state tries to bridge reality with paper. Money issuance accelerates. The logic is always the same. We'll print now and grow out of it later. But printing is not growth. Printing is a claim on future production. If the future production can't meet the claim becomes a lie. Stage 3, the snap. Crisis accelerates everything. Confidence doesn't slowly fade. It breaks. People spend immediately because holding currency becomes a guaranteed loss. Prices stop being prices and become moving targets. The currency fails as a store of value, then fails as a unit of account, then fails as money. Stage 4, stabilization only comes when rules change. A new unit is introduced, tied to something real enough to re-anchor trust, and obligations are restructured. Again, the point is not hyperinflation is always next. The point is that once a society uses printing as its main bridge between promises and reality, it eventually reaches a point where printing no longer buys time. It only broadcasts weakness faster. Verified. Third case study. The United States from Bretton Woods to the 1970s. This is the one most people think they understand, but they usually miss the mechanism. Stage 1, after World War II, the U. S sits at the center of global trade. Bretton Woods creates a framework where the dollar is redeemable for gold internationally. Trust is high. The dollar becomes the operating system of settlement. Stage 2, costs rise. Vietnam, Great Society programs, Cold War competition, domestic promises. Meanwhile, global trade expands and the world needs more dollars. But a gold-linked system can't supply infinite dollars without eventually undermining the promise. The reserve issuer must supply liquidity, and that liquidity eventually stresses the backing. Stage 3, foreign holders notice the math. Doubt spreads. And then you get the inflection. 1971, convertibility is suspended. The promise structure changes. The currency becomes more elastic, more political. The 1970s deliver inflation and shocks. The public learns that official language and lived reality can diverge. Stage 4, hard assets reprice. Gold explodes upward through the decade. Silver follows, becoming public obsession by 1979 and 1980. Then policy tightens. Volatility crushes late entrants and prices collapse. But the system does not return to the old world. The old world is gone. A new era begins. Deeper leverage, larger cycles, and a fiat regime where the discipline is political, not metallic. Undeniable. Now, quick recap, because if you can repeat this, you can see through the headlines, credibility first, then overextension, then loss of control, then repricing and reset. If that makes sense so far, type the word pattern in the comments. Not for the algorithm. Do it so your brain locks the sequence in. And here's the simple test I promised. One question. If you can answer it, you understand the present. Are we in a world where paper claims and physical reality are still tightly bonded? Or are we entering a world where they separate? Because that separation is stage 3. And silver is one of the fastest instruments to reveal it. Before we apply the pattern, here's the indicator. Watch whether premiums and spreads shrink after big up days, or whether they stay stubbornly wide even when price dips. In normal rallies, the spread snaps back because supply is available and arbitrage works. In stressed rallies, the spread stays wide because the problem isn't enthusiasm, it's allocation. If you see dips that don't fix the premium, that's the system quietly telling you supply is tight where it matters. Hold that thought. Now we apply the exact same pattern to right now, step by step, like a forensic checklist. No vibes, no hopium, just mechanics. Stage 1 today, credibility. After 2008, Central banks proved they could stop cascades with liquidity. After 2020, governments proved they could run enormous deficits without immediate collapse. Markets learned a dangerous lesson: downside will be backstopped. That doesn't just change finance, it changes psychology. It teaches people to stop fearing the limit. Credibility wasn't earned through restraint. It was earned through intervention. And intervention can look like competence right up until it stops working. Check. Stage 2. Today, overextension. Global debt remains around $251 trillion, still above 235% of global GDP. The system isn't deleveraging, it's stabilizing at altitude. And in the US, geopolitical debt around $38.4 trillion is not a statistic. It's a constraint. Because when debt is that large, normal interest rates become abnormal pain. Interest expense becomes political. Fiscal choices narrow, and the temptation returns. Instead of paying the bill directly, stretch it across time. That is debasement by design. Not always dramatic, not always announced, but baked into incentives. Verified. Stage 3 today, the phase shift. You can feel it in ordinary life. Prices that don't move like they used to. You can see it in markets, volatility that refuses to die. And you can spot it in one place where the system cannot hide. Physical bottlenecks. This is why the China U. S divergence matters so much. When Shanghai trades push above 125, while US pricing is around 110 to 115, you are watching geography reveal stress. You're watching a region pay for certainty while another region leans on benchmarks. And here's the deeper point. In a calm regime, there is one silver price. In a stress regime, there are many. There is the futures price, there is spot, there's the price for immediate physical delivery, there is the price for large bars. There's the price for small retail units. There's the price after taxes and VAT in local markets. There's the price once you include conversion, transport, and availability risk. And when those start moving in different directions, it means the market is no longer one pool. It's multiple pools with gates. Splits don't happen in stage 1. Splits happen when the promise network is straining. Undeniable. Now, stage 4, what tends to happen next? This is where people want certainty. They want me to say, silver will be X dollars by Y date. That's not how real systems work. But I can tell you what the machine usually does next because it has limited options. Option 1, the market clears through price. Prices move violently higher until demand is rationed. Substitution kicks in and hidden supply comes out. This is the US catches up pathway. Premiums narrow not because China collapses, but because Western price discovery is dragged upward by reality. Option 2, the split hardens. You get persistent regional premiums. Flows reroute. Arbitrage becomes constrained by policy, logistics, or capital controls. The benchmark price becomes less relevant to the people who actually need the metal. And once that happens, you can live in a world where the screen says one number and the real world says another. Option 3, rule changes. This is the one people hate discussing, but it's in every historical playbook. When a claims-based system meets scarcity, the system protects itself. It can raise margin requirements. It can adjust contract terms. It can push cash settlement incentives. It can change what counts as acceptable delivery. These are containment tactics. They are not conspiracies. They are predictable responses to stress. If you want a single-sentence summary of stage 4, it's this. When the system can't create metal, it changes rules about claims. Now, I promised you'd know which stage you're in. So here's the diagnostic, and I want you to answer it honestly. Are you seeing headlines about record prices and outsized yearly moves in silver? Are you hearing stories about premiums and regional divergence? Are you noticing that spot price and street reality don't feel like the same thing? If yes, that's stage 3 energy. That's the phase shift. And stage 3 is where people make the costliest mistakes because it feels like free money right before it becomes expensive tuition. So here's the practical takeaway without hype. Stop thinking in single prices. Start thinking in system states. In a calm regime, the only question is, what's the price? In a stress regime, the questions become, what's available? What's the premium? What's the settlement risk? What happens if rules change? What happens if the spread between regions widens? This mindset alone will protect you from the most common trap, confusing a bullish thesis with a safe environment. And if you're watching this and you're younger or you're building your base, here's what matters most. Don't build your life on the assumption that stage 1 will last forever. Build for resilience. Avoid fragile leverage. Keep optionality. Understand that forced liquidation is what ruins people in volatile regimes, not being wrong on the long-term direction. Now let me do the what not to believe, because these myths destroy people the way they destroy attention. They sound comforting, and they hide the mechanism. Myth 1, American exceptionalism means the pattern doesn't apply. It does. Empires always believe they are exempt from history until history sends the invoice. Myth 2, modern economics solved the debt problem. It didn't. It built smoother tools to postpone it. Postponement is not resolution, it is time shifting. Myth 3, technology will save us. Technology can boost productivity, but productivity doesn't automatically repair a credibility crisis in the unit of account. And myth 4, silver is just speculation. In a normal year, maybe. In a stress regime, silver is both a strategic input and a monetary mirror. When it starts behaving like this, it's telling you something about confidence, constraints, and the cost of real things. So here's my final warning, and I'm going to say it as plainly as possible. The split you're seeing, China higher, US lower, is not the story. It's the symptom. The story is the machine completing its cycle. Credibility built, overextension normalized, control slipping, and the reset pressure rising. And once reset pressure rises, the public always arrives late, because the public waits for permission to believe what the market already priced. Don't wait for permission. If you want, in the next video, I'll map stage 4 in detail. What containment looks like, what a paper-to-physical separation does to price discovery, and how resets actually unfold without warning headlines. And I'll show you 3 signals that usually appear right before a market goes from volatile to discontinuous. So subscribe, follow, and watch the next one. Because understanding the machine is the difference between being shocked by the next phase and recognizing it as the inevitable output of inputs you can already see. If you want, paste your channel niche, shorts versus long form, average view duration, typical video length, and I'll tailor the pacing even more tightly to your audience profile, still without adding headings.